If your household income is above $165,000 as a single filer, or above $246,000 as a married couple filing jointly, the IRS says you cannot contribute directly to a Roth IRA. Not at all. Not even a dollar. And for a lot of high earners, doctors, engineers, dual-income couples in their 30s and 40s, that feels like a door slamming shut on one of the best retirement accounts ever created. Tax-free growth, tax-free withdrawals, no required minimum distributions. Gone, because you make too much money. Except it's not actually gone. There's a completely legal, IRS-approved workaround that's been widely used for over a decade, and Congress has repeatedly chosen not to close it. It's called the Backdoor Roth IRA, and today I'm going to show you exactly how to execute it, and more importantly, how to avoid the one mistake that turns it into an unexpected tax bill. The Backdoor Roth IRA is not a special account type or a product you buy from a financial institution. It's a two-step process that exploits a quirk in the tax code. Here's the quirk: while there is an income limit for direct Roth IRA contributions, there is no income limit for Roth IRA conversions. You can convert a traditional IRA to a Roth IRA regardless of how much you earn. There's also no income limit for making non-deductible contributions to a traditional IRA. You can't deduct those contributions from your taxes if you have a workplace retirement plan and your income is above a certain threshold, but you can still make them. The Backdoor Roth takes advantage of both facts simultaneously. Step 1. Contribute to a traditional IRA with after-tax dollars, a non-deductible contribution. Step 2. Convert the traditional IRA to a Roth IRA. Because you already paid tax on the money going in, the conversion itself creates little to no additional tax. The result: you've effectively funded a Roth IRA despite being over the income limit. The contribution limit in 2025 is $7,000 per year, or $8,000 if you're 50 or older. That may not sound huge, but at a 7% annual return, $7,000 per year compounded over 20 years becomes about $300,000, completely tax-free. Here's exactly how to do it. First, you need a traditional IRA at a brokerage. Fidelity, Schwab, and Vanguard all support this process and make it straightforward. If you already have one, great. If not, opening one takes about 10 minutes online. Second, make a non-deductible contribution of $7,000 to your traditional IRA for the current tax year. You can do this any time between January 1st and the tax filing deadline, typically April 15th of the following year. Important note: you are contributing after-tax dollars here. You're not getting a deduction for this contribution, and that's intentional. Third, as soon as the funds are available, usually 1 to 3 business days after the contribution settles, convert the traditional IRA to a Roth IRA. Most brokerages let you do this online in about 5 minutes. You select Convert to Roth, choose the amount, and confirm. Fourth, file IRS Form 8606 with your tax return. This form tracks your non-deductible IRA contributions and ensures the IRS knows you've already paid tax on these funds. If you skip this form, you'll end up being taxed on the conversion even though you shouldn't be, so don't skip it. That's the clean version of the process. But there's a major catch I need to explain before you do anything. The Pro-Rata rule is the landmine inside the Backdoor Roth, and it catches a lot of people off guard. Here's how it works. When you convert your traditional IRA to Roth, the IRS doesn't let you say, "This money I'm converting is the after-tax money I just put in." Instead, the IRS looks at all of your traditional IRA money, from every account, combined, and calculates the ratio of pre-tax to after-tax funds. Then it taxes your conversion based on that ratio. Let me give you a concrete example. Say you have a rollover IRA with $93,000 in it, all pre-tax money from an old employer's 401k. You then contribute $7,000 after tax to a new traditional IRA and immediately try to convert just that $7,000. The IRS looks at your total traditional IRA balance, $100,000. Of that, $7,000, or 7%, is after tax. So when you convert $7,000, only 7% of it, $490, is tax-free. The remaining 93%, or $6,510, is taxable income. If you're in the 24% bracket, that's a $1,500 surprise tax bill. This is exactly what happens when people do the backdoor Roth without understanding the pro-rata rule, and it completely undermines the strategy. The solution to the pro-rata problem is to have zero pre-tax money in any traditional IRA on December 31st of the year you do the conversion. That means if you have a rollover IRA from an old job, you need to deal with it before you execute the backdoor Roth. The best option for most people, roll the traditional IRA back into your current employer's 401k plan. Many 401k plans now accept incoming rollovers. You'd call your plan administrator and ask if they allow IRA rollover contributions. If they do, you roll the pre-tax IRA money into the 401k, and now your total traditional IRA balance at year-end is zero. The only IRA you have is the fresh $7,000 non-deductible contribution you just made, and that converts completely tax-free. Another option, if you're self-employed or have a solo business, you could open a solo 401k and roll the IRA into that. We'll cover solo 401ks in a future video. They're extremely powerful for the self-employed. The one thing you should not do is just leave a large pre-tax IRA sitting there while doing a backdoor Roth conversion and assume it'll be fine. It won't be. Run the pro-rata calculation first, solve the pre-tax IRA problem, then execute. Question 1. Can my spouse also do a backdoor Roth? Yes. Each spouse can contribute to their own IRA separately. If both of you are over the income limit, you can both do the backdoor Roth, potentially contributing $14,000 after-tax dollars per year between you, all eventually growing tax-free. Question 2. What if I already made a deductible IRA contribution this year? That gets complicated quickly. Talk to a CPA before converting in that case, because the pro-rata rule will apply. Question 3. Does the two-step process, contributing and then immediately converting, raise any red flags with the IRS? Technically, the two-step transaction doctrine is a concern some people raise, but the IRS has explicitly stated in legal guidance that the backdoor Roth is permissible, and it has been widely practiced for years without challenge. Question 4. What should I invest in once the money is in the Roth? Whatever you'd hold in any Roth account, ideally high-growth assets like total stock market index funds, since all gains are tax-free. The Roth is one of the few places where you want your most aggressive, highest upside investments because none of that growth will ever be taxed. Let's bring it all together. The backdoor Roth IRA is a legal two-step process. Contribute $7,000 in after-tax money to a traditional IRA, then convert it to a Roth IRA. The only serious risk is the pro-rata rule. If you have other pre-tax IRA money sitting around, a percentage of your conversion will be taxable. The fix is to roll any pre-tax IRAs into your employer's 401k before December 31st of the conversion year. Once you've done that, the process is clean, repeatable, and takes maybe 30 minutes per year. File Form 8606 with your taxes every single year you do this, no exceptions. Over 20 or 30 years, the tax-free growth from consistent backdoor Roth contributions can add hundreds of thousands of dollars to your retirement that the IRS will never touch. Next up, we're covering the Mega Backdoor Roth, which lets certain 401k participants contribute up to $43,500 extra dollars per year beyond the normal limits. That's the subject of video 53, and it's one of the most powerful strategies in personal finance. Subscribe so you catch it.